Sabharwal joins in on the show right now. Sandip, hi, good morning. Good to have you on the show. The FI, Sandip, clearly seem to be making a comeback. I don't know for how long, but at least it's a healthy buy figure so far this month at least. But does it seem like that the rough patch of September, October is behind us? Or do you think the litmus test will be in January when we have the next quarterly earnings?
Yeah, so so FI flows have been erratic. So earlier, beginning of fourth quarter, I think the flows started to become a bit positive. Then they became quite negative. So I think tracking these flows to make investment decisions is going to be difficult, and that is ideally, what in what investors should not be doing. So when some selling creates opportunities to buy, and if you are bullish on the markets, then I think we should be buying. So I think that's the perspective. Now, looking at the market overall market seems to be decently placed in the sense that we have had a rough patch of economic growth. Now, incrementally growth improvement should is imminent, and that we should see this quarter and next quarter. The key is that whether we can have an accelerating growth momentum, because the RBI also cut down the growth forecast as was expected after the second quarter results, what we saw from the companies also. So I think we should not be very negative on the markets. So 2025 should be decent, and as usual, it will be specific stocks, specific sectors that could do well. And I would look at it this way. I would be reasonably positive for 2025.
Okay, interesting. Sandeep, but what about some of the beleaguered sectors like a staples? And we've discussed this time and again as to when we saw the rural spending also take a hit. But you thought that, some of these stocks are interesting buys because they've been so beaten down. And, the reason that I ask is Godrej Consumers and the spate of downgrades that have come in, even from the house of MK, for instance, they've cut the earnings by a good 4 to 7%.
Yeah, so initially many of the a large part of the current downgrades have are led to raw material inflation, especially palm oil, because palm oil prices, first the government increased the import duties and then the palm oil prices shot up. So it's been a double whammy both for consumers as well as companies. So that will definitely impact near-term profitability, and the growth trends have been sluggish. Now the key is that whenever many of these stocks fall 30-40% from the top, especially on the consumer side, FMCG, they are usually buying opportunities, because that reflects extreme negative sentiments, and as those sentiments build up, you buy, because whenever positive news flow comes through from FMCG, like just 3 months back, there was an expectation that consumer demand will revive, and many of these stocks just shot up. So the key is to buy them early, because the biggest feature of many of these stocks is that they don't raise equity. Like the consumer good companies don't raise equity, so the equity remains the same. So when most old investors tend not to sell. So whenever there is positive news flow, new investors come in, and then the stocks move up. So I would think that they are reasonably priced. We should slowly be nibbling into these stocks. Uh, the impact of the input price hike, especially palm oil, that was somewhat unexpected till couple of months back. So that will impact the next 1 or 2 quarters profitability for sure.
So, Sandeep, if they were to decline further today, where is it that you would pick stocks or add to positions within staples?
So among staples, Tata Consumer has corrected a lot from the top. Godrej Consumer has corrected reasonably. We have seen HUL correct. So because of the recent demerger news and analyst meet, it saw some uptick. So that could also moderate a bit more. Then there's Dabur. So all of these companies are very strong companies for the long term, and you can get decent value for them only when there's negative news flow.
All right.
Sandeep, what do you make of some of these classic MNCs, Bosch, maybe to some extent 3M, the classic Bayer Cop Science. These are classic MNCs which have not really done anything exciting in the last couple of years.
I think these companies were preferred stocks at a time when many of the Indian companies did not do as well, and uh, there were less growth opportunities, and there was a favor towards buying the MNC stocks. But lately, what has happened is there is much more choice for investors. But some of the companies obviously continue to do well, and 3M is a huge global innovation company, and they continue to expand the footprint in India with their new products, etc. So I think to that extent, that continues to do well. Bosch is facing its own struggles with the shift towards EVs, etc. So and the growth challenges it presents. So I think that's something which is there. Bayer and all, so agrochemical industry, all of us know, has been going through a phase of doldrums for the last 2 years. But despite that, I think Bayer has relatively held on. So, but in terms of valuations, for people who just track valuations, I think the valuations of all these companies obviously are very, very high, and they have remained high for a long time.
What is the trade now from here to, let's say, for next 12, 15 months? Is it defensives? Is it IT? Is it capex? What is that big overlying trade?
I think many of the capex oriented companies, power, focus capex, or something like L&T, like L&T is consolidated throughout this year. I believe that it's very well placed to do well over the next couple of years. So many of the companies had a phase of lower execution, lower order bookings during the elections, etc., which has now passed and which we'll see coming through. And so I think those themes should do well. IT selectively, some companies have done well. There is an expectation that there'll be some sort of revival next year. But we also hear of the kind of budget cuts or rationalizations that the new US regime is talking of. So, what impact that has on overall sourcing requirements as well as economic growth in the US is something we need to track. Consumer stocks selectively have done well, so I think they'll continue to do well. Many of these, although I haven't bought so much of the EMS theme, but many of these companies continue to expand the footprint, get in new clients, etc. So potentially they could still continue to do better.
2025 to be another solid year for Dixon, Amber, Keynes. Sandeep?
It potentially could be because from whatever we keep on reading and we hear the managements, they are continuously adding new clients, and the PLI benefits is something which is helping them gain clients. Otherwise, it's a very low margin business. So historically, I haven't had like this business because the margins are so low, and the only way they tend to make profits are due to large government incentives. But then they have sustained, they have gained new clients, and it's a sector many investors cannot ignore.
Okay.
Mobius the Santa says that look at Newgen. I've been looking at that stock. Sandeep, Infosys is at an all-time high. And I'm just wondering if I've missed any headline in the last 3 months. Nothing has changed for the sector. If at all, AI has only becoming more and more mainstream. But the fact that Infosys has hit an all-time high for a company which is still struggling to give double-digit concrete growth, what are markets excited about?
Many of these technology stocks have a linkage to Nasdaq movement. So if you actually correlate the movement of the Indian IT stocks to Nasdaq, you see a very high correlation. Although the growth drivers for many of the Nasdaq companies and that of Indian technology companies are totally different. So I think that's what has driven, because global technology fund flows come in, etc. And then running into the election phase, people were defensive. So IT's become a lot of defensive phase, defensive space also. Like in the market correction, it actually outperformed. So I think those are things driving, like, but you likely said that the growth is not going to go into double digits in the near future, or I don't know whether ever it will go back into double digit. So the valuations at which the stock trades now is excessive relative to the growth it can give.
Which consumer numbers are anything to go by, it clearly appears that for the consumer staple space right now, the stress is far from over. And in the near term, when it comes to the recovery hopes, especially for the soaps, shampoo, that staples category is unlikely to filter in. And something, Sandeep, it actually amazes me, right? We had a good monsoon, inflationary pressure have been moderate. And yet, when it comes to some very basic categories, soap, shampoos, toiletries, those categories are not growing.
That's because consumer pockets have been under stress, and because of inflation in vegetables, food articles, etc. And on top of that, we've had uh, overall income wage salary growth, which has lagged the kind of price moves which we have seen, especially some of them import led, some of them due to increase in duties, etc., and taxation remains high. So I think consumer demand in India, unfortunately, has been subdued for, I think, now more than 2 years. So it will revive eventually, but then the wait gets longer.
So then what does one do in the interim? Start accumulating these stocks or wait for the turn, and when the turn comes for 2 quarters, then buy them?
No, I don't think waiting for the turn in many of these stocks makes any sense. So whenever these stocks are down, let's say, so my benchmark always has been 35% from the top. So whenever you see them down 35% from the top, you accumulate them. And many of these stocks are near those levels. So maybe the 5, 7, 10% because of negative news. If they come down, then we get good opportunities. And the expectation of returns from these companies is maybe when you buy them at decent valuations with a potential 2 year revival cycle, 15 to 18% 2 3 year CAGR, which in my view is quite good.
There are two more stocks which have done very well, and they're from the PSU space, PFC and RSC. While they move together, they go up together, they go down together because there is a linkage in the business model and ownership. Where are these two stocks headed, Sandeep? Because A, they are PSU, B, they are power, and C, they are NBFCs, which should gain if interest rates come down.
So NBFCs tend to be bigger beneficiaries than banks on a interest rate reduction cycle as well as liquidity improvement. So obviously NBFCs are much better placed. PFC, REC, the main issue is that they are one sector focused, and on the solar side, so I think near term looks okay, but longer term on the solar side, I think there'll be a lot of stress eventually, given the pace of capacity build up, the fact that many of the new solar investments are finding it very difficult to sign PPAs, etc., and many of them are funded by PFC and REC. But that's a story of 2 3 years later, and many investors will not look that long. So near term, the PSU bounce back could potentially continue. But if I had to buy NBFCs, I would buy more the private sector ones which have got better, like something like L&T Finance or Mahindra Finance, which could benefit because M&M also is indicating an uptick in tractor demand, etc. And all of those stocks are also down nearly 30, 40% on the tops, which we saw earlier during the year.
Okay. If you like this video, then like, share and subscribe to ET Now.